Welcome to Talk Tickers, where we break down the earnings reports that are really moving the market. Today, we are digging into the luxury marketplace 1stdibs, ticker DIBS. Their third quarter numbers just hit the wire, and wow, the market reaction was something else. Let's get into it.
And I mean, just look at this. On November 7th, the day they reported, the stock absolutely rocketed, closing up more than 15%. That's a huge one-day move for any company. So that's the big question, right? What on earth was in that report that got investors so fired up? What drove this massive pop? Well, that's exactly what we're here to unpack.
Okay, first things first, let's just look at the headline numbers. And honestly, the simplest way to say it is this. They beat expectations, and they beat them pretty handily.
When you look at the details, it's just a clean sweep. Their loss per share came in at 10 cents, which was actually 3 cents better than Wall Street was bracing for. Revenue of $22 million also sailed past estimates. And gross merchandise volume, that's just a total value of all the stuff sold on their site, it landed at $89.1 million, right at the top end of what they told investors to expect. A really solid quarter all around.
But here's the thing, those top-line numbers, they weren't the real story. The number that made everyone sit up and take notice is right here. Adjusted EBITDA margin. It's a key measure of profitability. A year ago, it was negative 14%. This quarter, it was basically break-even at negative 1.1%. That is a massive 13-point swing, the best they've ever posted as a public company. This is what really got Wall Street buzzing.
And look, this kind of dramatic turnaround doesn't just happen by accident. No, this was the direct result of a very deliberate, company-wide pivot toward profitability.
You don't even have to take my word for it. The CEO himself called it a breakthrough period. Management made a very clear strategic choice here. They decided to focus on financial discipline instead of just chasing growth at any cost. And boy, did it pay off.
And this is exactly what that strategy looks like when you put it into numbers. You can see the trade-off they made crystal clear. On the one hand, yeah, the total number of orders was actually down about 4%. But on the other hand, look at the value metrics. The average order value shot up 10% to almost $2,700, and their gross margin expanded by 330 basis points. That's a huge 3.3% jump. So they were perfectly happy to take fewer orders, as long as those orders were much more profitable. It's a classic quality over quantity play.
So how'd they do it? Well, it came down to a few really key, decisive moves. First, they pulled way back on marketing spending. Second, they moved people from sales roles into product and engineering to make the platform better. And third, they worked on getting better terms from their vendors. All of this just fundamentally lowered the cost of doing business. And then, to really put a cherry on top, the board showed its confidence by announcing a new $12 million share buyback program.
And one of the biggest benefits of this whole shift is how much it proves the strength of their brand. I mean, think about it. They're spending less on advertising, and yet over 75% of their traffic is now organic. People are coming to them directly. That is a huge, huge competitive advantage because it means your cost to acquire a customer just plummet.
Okay, so we know the what and we know the how. But the really important question is why. Why did the market reward this pivot so aggressively right now? To get that, we need to zoom out and look at the bigger picture.
I mean, this slide tells the whole story, doesn't it? Over the last month, DIBS stock is up around 75%. In that same period, the S&P 500 was basically flat to down, and their own consumer discretionary sector got hit even harder. This wasn't just a good quarter in a vacuum. This was a massive outperformance in what's been a really tough environment for consumer stocks.
And here's why that matters so much right now. The whole investing narrative has changed. The days of growth at all costs, when investors would throw money at companies just for getting bigger, well, those days are over. In a world with higher interest rates, investors are hunting for one thing, a clear, believable path to making actual money. And 1stdibs just served that story up on a silver platter.
So that's the full story of Q3. But you know how this works. With the stock up this much, all eyes immediately turn to the future. So for our final segment, the next call, let's break down what we should be watching for in their Q4 report.
First, let's look at what management themselves are forecasting. GMV and revenue look pretty stable, but the real headline here, the one to circle, is the Adjusted EBITDA margin. They are guiding to positive 2 to 5%. If they hit that, it would be their first ever quarter of positive adjusted profitability. That is a huge milestone.
And what that does is it sets up Q4 as the critical proof point. This is the moment of truth. Management has to prove to the market that this new, disciplined, profitable model is here to stay, and that Q3 wasn't just a one-hit wonder.
Okay, so here's our thesis for the next call. Our prediction is that they will hit the high end of their guidance. Their execution has been fantastic, and we expect that to continue. Now for the stock price, because it's already run up so much, just meeting expectations might cause the stock to trade sideways for a bit, kind of digest the gains. But any kind of a beat could send it higher. The key risk? Watch those margins like a hawk. Any sign that they're slipping could quickly undo a lot of these recent gains.
So, tying this all together, we are rating the stock market perform. Let me be clear. The operational turnaround here is incredible, and management deserves a ton of credit. But with the stock up over 75% in a month, we think a lot of that good news is already baked into the price. We need to see them deliver on that Q4 promise before we're ready to get more bullish.
So for now, we'll watch and wait. The big question is whether this pivot is a permanent change for the company. That's what we'll be looking for on the next call. And just as a final reminder, this is not financial advice.